Welcome to the Jeff Crilley Show. And now, here's Jeff Crilley.
Welcome back to the Jeff Crilley Show on this beautiful Saturday morning. We're talking about buying and selling businesses now. My guests, Dennis Burns and Don Zaleski from the Burns firm. Welcome to the Jeff Crilley Show.
Thank you, Jeff. I'm
Good
glad
morning.
to be here.
So, Dennis, let's start with you. So you've been at this for a little while now.
I have. I've been a CPA for 30 years. I have an emphasis, a master's in tax. So we really focus on tax, and our practice has started out as a lot of tax preparation, IRS controversy, and we built a great practice on that. And it's developed over the last, probably 15 years into a lot of business transactions. Meaning that the tax issues in a business merger and acquisition are always a big issue, and everybody's trying to minimize those taxes. And so that's where we specialize a lot and try to put emphasis in along with our tax practice.
And that's when you brought Don in?
I did. I brought Don to help manage that, and he's done a great job, and we're really excited about the merger and acquisition part of our practice.
Don, let's bring you in on the conversation. So what's one of the classic mistakes people make when they buy or sell a business?
Significantly, when they're selling, business owner will often feel like his business is worth far more than what it really is. And if he would just allow folks like ourselves to assist them a few years earlier, we can start to help prepare them in such a way that the ultimate value that we can get and help them keep is going to be significantly larger.
And Dennis, we were talking off the air about the idea that everybody's trying to minimize their taxes, but when it comes to selling your business, that might not be a great idea.
That's exactly right, Jeff. And what happens is the private business owner is always interested in minimizing his taxes however he can. And by buying assets perhaps or just running things through his business that minimizes his taxes. And that's the wrong thing to do when you sell your business, because the buyer looks to the profitability of the business. And if you've depressed the profitability by all these other expenses that you had running through the business, you really depressed the purchase price. So it may sound counterintuitive, but when a business owner is getting ready to sell his business, he ought to maximize the amount of profit and maximize the amount of tax that he pays.
And how far out should you do that?
Well, certainly at least 3 years, because a lot of buyers look at a 3-year period. And there are some tax elections that take place and have a effectiveness after 5 years. So I had a client that had a highly appreciated building in Addison Airport. And I went to him and I said, you should make this election. It'll take effect 5 years later for you to minimize your taxes. And he said, well, my business is not for sale. My building is not for sale. And I said, well, I understand that now, but it's going to be at some point in time. And he says, well, sure. So it was hard to get him to think about 5 years out.
Right.
But that's exactly what we did. We made this election, this tax election, that will take place in 5 years. So he's planning ahead for the sale of his business in 5 years. So I would say, in answer to your question, it's really 3 to 5 years out that you need to be thinking about selling your business.
What about selling to your kids? Is that a good idea, a bad idea? And as far as the tax burden is concerned, how do you go about doing it with the least amount of pain?
Well, and selling to your children, a lot of people do that. A lot of people, or some people, want to make that taxable, want to have that business income as their retirement, or the sale of the business as their retirement income. And some of them just say, well, my dad, I just sort of came in and took over the business, and there wasn't a lot of tax issues. There weren't a lot of payments out. And so we can do it either way. It just depends on the interest level of the father and the son and or family and what they do. So it's a good idea. Certainly it is. And I like to see a lot of businesses transition to the second and third generation. It just depends on how you want to do it. And a good tax person can help you with the tax issues in that transaction.
Don, let's bring you back in on the conversation. We had the Great Recession in 2009, 2010. What have we seen here in the last 6 years in terms of people buying and selling their businesses? Has it been brisk or slow?
It has been picking up significantly. There are numerous factors that are driving that. One of them, the not great returns in the stock market over a number of years, has driven a lot of money into these private equity groups that buy businesses. So there's a lot of money available for acquisitions. You also have the graying of America. Statistically, about half of all of the privately owned businesses over the next 15 years will transfer. That's a significant number of them, and it's based on the age of the people who own and run the business. The other thing that we're seeing is profits back. 2008, 2009, 2010, businesses got themselves so lean in order to survive. Those that did survive were lean, and as revenue started to climb back up, so did their profits. So profits are up. There's available cash in the marketplace. Business owners are aging. It's probably a very good time to begin to consider these things and get ready.
Dennis, is it smarter to just buy the assets of a business than actually buy the business?
Well, it depends on whether you're the buyer or the seller. Many sellers believe that the buyer will buy the stock and make it a simpler transaction. And by buying the stock, you reduce the taxes. You just have a capital gain. But that's not generally the case. Generally, the buyer wants to buy assets, defined assets, and define liabilities. So it creates potentially another level of tax if you're not set up correctly. If your business entity is not set up correctly, you may have a second layer of tax. So the buyer wants to buy the assets and liabilities. Seller generally wants to sell the stock, but the buyer generally prevails, and it's an asset sale most often than not.
So if I was buying a flower shop and you were counseling me, would you say go ahead and buy the flower shop or just buy the inventory, buy the building? I mean, is there a difference between buying the company and buying everything in it?
Certainly there is. And if you were my client as a buyer, I would tell you very clearly to buy the assets, buy defined assets. We get to allocate then a particular price to the assets, and then we get to determine what liabilities, if any, we want to buy. And so it's a much better transaction for the buyer when he buys assets and liabilities.
Let's just talk about business taxes in general. Are they pretty favorable here in Texas?
Well, you have a federal tax, which affects everybody in the United States, and then Texas has limited state taxes. We don't file any personal income taxes on a state level, although Texas does have a franchise tax that a lot of businesses are not affected by the franchise tax because of the exemption amount when they're operating. And then when they go to sell it, they are oftentimes surprised about a franchise tax, that it may push them into a taxable situation for franchise tax, for a state corporate income tax, really. So Texas is generally very favorable. It's a great state to do business in tax-wise. Everybody pays the same federal tax, but there is that franchise tax that that may potentially affect a business sale.
Don, it seems like every time we see one of these top 10 lists of best places to do business, Dallas-Fort Worth is right up there in the top 10. Why is that?
Probably because of the influx of all of the people that have been coming into the marketplace. My understanding is over 400,000 people a year come into DFW. That actually creates competition for jobs. Many companies go out of their way to get the accolades of best place to work because you get to hire the best people, and a business is a product of the performance of all the individuals in the company.
Well, I was talking off the air that you're a pilot and you actually fly quite a bit. I mean, is it your daily commute?
Yes, it is generally. I live on a ranch north of Dallas, and I've finished a house and then cleared some land, and I put in a runway. I put in a grass strip where I take off and land on a almost daily basis. So it's where I live. It's an hour and a half from Dallas, an hour and a half drive in a car, and it's a 23-minute flight in my Cessna airplane. So.
Does it ever get boring?
No, it never gets boring. It's in part because it may sound counterintuitive, but I'm afraid of heights, and that's one of the reasons I started flying was to overcome this fear of heights. And I find that if I don't fly about every 6 or 8 days, I get a little queasy about getting up and flying. But it's a great trip from the ranch to Addison, and it never gets boring. I can promise you that.
Well, what happens when the weather is rough? That's got to be a challenge?
Well, if the weather is too rough, I drive. If it's really windy or if it's lightning or something like that. But generally, we're blessed with some nice weather in Texas, and so I don't know how many days, but it's probably 250 days, or probably out of a year, or probably VFR weather, visual flight rules, for a pilot to fly in. And so many of the days I fly in, it's hot on the ground, but once you get up to altitude, it cools off some, and then I'm able to land in Addison, and it's just a great experience.
As a business expense, is a plane a good move?
Well, I hope no IRS agents are listening now. But of course, it's a good move. Of course, it's a ordinary, necessary business expense that I have to use. So, yeah, it's a great move, and the plane is a lot of fun.
Frankly, it helps our business. It is a business expense.
He can fly all over, too.
We do. We go see prospects that are outside of the major metropolitan areas, and there are so many little airports. We're able to drop down, 5, 6, 8 miles away from that man's place of business and go in and visit or bring prospects to him. We think it's a competitive advantage to doing business with the Burns firm, frankly.
I like that. Now, Dennis, you also do a lot of public speaking. What are some of your favorite topics?
Well, I've spoken on tax consequences of a business transfer for many years. I taught the Texas Association of Business Brokers for over 10 years on that transaction. We've taught on protecting assets from the IRS, how to minimize taxes in estate and income tax side. So we've done a lot of that, and it's been a lot of fun.
Well, this is great. Tell me about what you see in your crystal ball for the economy for the Burns firm. Do you see 2017 being a good year?
We do, yeah. When we look at all the opportunity, we see the clients' businesses improving, our reach in the marketplace growing significantly. We work with, and this may sound unusual, but we work with our fellow CPAs. They have clients that their businesses are maturing, and they want to work with another firm that's of a similar professional level, and they're not necessarily going to be out there soliciting buyers for that client. We're good at that, and we're good at working with them. So yeah, the horizon is getting bluer and bluer. No airplane jokes.
Dennis, do you get most of your new business from referral?
We do. My clients, kind of like me, are aging and maturing. I like to call it maturing rather than aging. And so it's a natural progression that they have. They've had their business for some time. They're interested in transitioning it either to their children, to their management group, or to a vendor, or to an outsider. So most of our transactions come through our client base and other people that know us and know that that's something that we specialize in. And like Don was saying, even other CPA firms refer clients to us that maybe they're not that familiar with the transaction, or they have some conflict with some of the earlier work that they've done. So it comes from all sides. But we're really excited about the Dallas-Fort Worth economy, the Texas economy in general. There's lots of positive things, and frankly, there always have been very positive things in Texas. Texas is a very good state to do business. It's a good state to fly in and out of as well.
I know a lot of business owners, they may be experts in some area, but they're not experts in running a business or certainly taxes. Do you find that some business owners start their company the wrong way? They're set up as a individual instead of as a S corp or a C corp, or?
Yeah, that's a good question, Jeff. I mean, a lot of the rules of thumb that we had early in my career have changed and continue to change with the tax laws that change, the rules of thumb that you would generally counsel a client on change with every tax act that's passed. So a lot of business owners just create an entity and stay in that entity and don't make any changes or don't update what they're doing or don't create separate entities, and that's a mistake. And the tax consequences can be enormous for the wrong kind of entity. They can a business owner can pay upwards of 50% of the taxes on the sale of his business because he's not organized in the most efficient fashion.
Wow, this has been a great conversation. Don, we'll let you have the final word. What do you want to leave the listener with?
Like everything else in our life, the more we prepare for where we're going, the better our end result is going to be.
Awesome. And what's the website, guys?
The website for the Burns firm is www.theburnsfirm.com.
Awesome.
Pretty simple.
Thank you so much.
Thank you.
When we come back, buying and selling a home in DFW, what does the market look like going into 2017? That's just ahead on the Jeff Crilley Show.
More of the Jeff Crilley Show coming up.